Is Cheniere Energy a buy or a sell? Let's get started with the model. This is a large cap company, 47 billion market cap. They're trading at $2.10 a share, and they have 225 million shares outstanding. Cheniere owns and operates 2 natural gas liquefaction and export facilities. They were incorporated in 1983, headquartered in Houston, Texas. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Look how much their free cash flow grew from 2021 to 2022, 8.7 billion. It did come down to 6.3 billion in 2023, down to 3 billion in the trailing 12 months. Not the best trend. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2021, positive 1.4 billion in 2022, nearly 10 billion in 2023, down to 3.7 billion in the trailing 12 months. Revenue is a sales for the company, and that doubled from 2021, 16 billion, to 2022, 33 billion. But it came down quite a bit to 20 billion in 2023, down to 16 billion in the trailing 12 months. Kind of an odd trend. They had really good numbers in 2022, then they came down a lot after that. I did find an article about the 39% revenue drop in 2023. Right here, the company says the reason for the 39% drop in revenue is due to lower oil prices, although its net income jumped compared to the year prior. We estimated 4 years of future free cash flows. We also estimated a terminal value. It's all cash flows past year 4, that's 59 billion. We discounted those numbers back to today using the weighted average cost of capital. We got a value of the company of $52 billion. We divide that by 225 million shares. And we get a calculated stock price at 232. They're trading at 210, so they're trading at a 9% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 45 companies in the same industry as Cheniere, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 2.4 billion. TC spends the most at 5 billion. They do have another stock listed, their MLP. That market cap is 32 billion. The stock we're looking at is 47 billion. A really high debt to equity ratio, 5.2. For every dollar of equity, $5.20 of debt. They pay a really small dividend, 1%. The average in the industry is almost 7%. Look at Frontline, 13.6%. They generate a lot of free cash flow, over 3 billion. They rank 6th in market cap. Actually, they should be 8th. They're small in these two companies. They're trading at 9.5 times book value. Price to book is stock price over book value per share. They're trading at 13 times earnings, which is equal to the median. 15 times free cash flow, a little better than the average, and about 3 times revenue, which is worse than the median average. They generate 16 billion of revenue, more than Williams, a little less than Targa Resources, and their 5-year annual revenue growth rate is 12%, which is higher than the median average. And the stock did come down a lot this year. It was down to 153 at its lowest, but it's currently at 210, which is getting closer to its 52-week high. If you put $10,000 into this company 10 years ago and reinvested the dividends, for 6 years you were in the red. But then starting in 2021, it ran up, and your $10,000 will be $30,000, a 12% annual return. Patience is a virtue. Sometimes you have to just wait it out, and your stock will go up. In this case, it did. To summarize, I have them trading at a 9% discount. I give them a ranking of 6 out of 10. I think for a short-term trade, it's okay, 6 out of 10. I think it's better long-term, 7 out of 10. Ratios are a little better than average, so I give it 6 out of 10. Financials don't look so good because their revenue has gone down so much since 2022. It's down 50%. Free cash flow is okay, but that also went down a lot since 2022. That's why I give it 4 out of 10. Let's take a look at their income statement. Here's the third quarter of 23, third quarter of 24. Revenue is going down. It was 4.2 billion, now it's 3.8 billion. LNG revenue, liquefied natural gas, went from 4 billion to 3.6 billion. And they have a very small amount of regasification revenue, 34 million. The difference between natural gas and liquefied natural gas is that liquefied natural gas is chilled and liquefied at very cold temperatures. That makes LNG 600 times more energy dense than ordinary gas. So it's much more efficient to transport. LNG is used in things like cooking, heating homes, electricity. The U.S. is the largest exporter of LNG. This year, we're on pace to export 93 million metric tons of LNG. A big problem with LNG is that it's composed of liquefied methane. Every stage of the LNG life cycle leaks methane emissions into the atmosphere. And I don't know if you knew this, but methane is a powerful greenhouse gas. It's responsible for nearly 1/4 of global warming. Global warming leads to extreme weather, crop loss, rising sea levels, and wildfires. Let's go back to their income statement. Let's see if they give a different breakdown of the revenue. You may be wondering what regasification is. That's the process of using heat to convert LNG from liquid to gas. That makes it a lot easier to transport and distribute. LNG must be regasified to be used as fuel. Okay, let's go back to their income statement. Below revenue are their expenses. Cost of revenue, $1.3 billion. These are all the expenses directly tied to generating the $3.8 billion of revenue. Operations and maintenance, $450 million. Then you have SG&A, selling, general, and administrative expenses, $100 million. Depreciation and amortization, $300 million. So their total operating expenses, $2.1 billion, up a lot from last year of $1.4 billion. So their operating income is down quite a bit. With lower revenue and higher operating expenses, their margins are squeezed pretty bad. It was $2.8 billion of operating income, now it's $1.6 billion. They have quite a bit of debt. They spent $247 million of interest on their debt, lower than last year of $283 million. They received $41 million of interest on their investments. So their other expenses, $209 million. Pre-tax income, $1.4 billion. $231 million of taxes, so their net income $1.2 billion. They had 226 million shares outstanding, so EPS is net income over shares outstanding. Their EPS is $3.95, a lot lower than last year of $7. They did reduce their share count by 14. Last year they had 240 million shares outstanding, now 226 million. So that's one bright spot. Let's see their balance sheet. $4.5 billion of current assets, $4.2 billion of current liabilities. So current ratio a little above 1. Current ratio is current assets over current liabilities. It's how well your current liabilities are covered by your current assets. You use current assets to run your day-to-day business. Current assets are more liquid than non-current assets. The most liquid asset is cash, $2.7 billion. That's the definition of liquid. Then you have restricted cash of $413 million. This is cash that's set aside for a specific purpose, like to acquire another company. Accounts receivable, $680 million. This is how much money other companies owe them when they sell products on credit. $400 million of inventory. Here's a breakdown of the inventory. $220 million of materials, $74 million of LNG, $80 million of LNG in transit. So that means it's in the pipeline right now. $18 million of natural gas and $2 million of other. Derivative assets, $94 million. This might be interest rate hedges or maybe foreign currency hedges. I'm not exactly sure what it is. Here's a breakdown though. $62 million liquefaction supply derivatives, $32 million LNG trading derivatives. They do footnote at 1 and 2. Footnote 1 does not include collateral posted with counterparties by using $28 million and $3 million as of 9/30/2024 and 12/31/2023. That doesn't really help. I want to know what it is, not what it does not include. Below that is $102 million of margin deposits. So this means they put a deposit on something. I can't find much info on that. And then other $109 million. Their big asset is PP&E, $33 billion. That's their LNG facilities. Here's a breakdown of the $33 billion. $34 billion is terminal and pipeline facilities. A little under $500 million of land, $5 billion of construction and process. They depreciated $7 billion, so the book value is $33 billion. Then they have other things like office equipment, furniture and fixtures, software, leasehold improvements. They also have $600 million of marine assets. They have $3 billion of operating leases. These are assets that they lease. They don't own it, they lease it from another company, but it's carried on the balance sheet as if they own it. Since it's reported as an asset, it does appear like they own it. Because assets are what you own, liabilities are what you owe. This $2.9 billion, they owe $2.2 billion operating lease liabilities and another $621 million in the current section. Deferred tax assets of $26 million. This will help reduce their taxes in the future. So total assets 43 billion, almost exactly last year, off by $1 million. Total liabilities 34 billion, similar to last year. Accrued liabilities 1.7 billion. This is when a company incurs an expense but hasn't paid it yet. Payroll is a common type of accrued liability. Here is a breakdown of their accrued liabilities. 500 million natural gas purchases, taxes 450 million, interest costs 300 million, compensation and benefits, that's what I was talking about, payroll 190 million, terminal costs 150 million. The current portion of their long-term debt is 700 million. Deferred revenue 189 million. This means they receive cash for a service, but they haven't provided the service yet. The current portion of operating leases 620 million. 800 million of derivative liabilities, and their biggest liability, of course, is long-term debt, 23 billion. Here's a breakdown of the long-term debt. It's a long list, no pun intended. Here's the interest rate for the notes. So they owe 8.8 billion on these notes. The interest rate is between 4 and 6%. SPL is Sabine Pass LNG Terminal. So this is the debt on that specific terminal. The CQP notes between 3.25% and 6%. 6.8 billion of debt. CQP is a ticker for their other company. If you type in CQP, that's Cheniere Energy Partners. That's their MLP. We saw that ticker on the competition chart earlier. That entity owns the SPL facility, the Sabine, and this is the debt on that entity. Then you have 5 billion of debt on CCH. That's their other facility, the one in Corpus Christi. Then 3 billion of debt on the Cheniere entity. Let's go back to the balance sheet. Assets minus liabilities equals equity, 9.3 billion of equity. They bought back 6 billion of their own stock, treasury stock. They raised 4.4 billion from selling their business, and they profited 6.5 billion from running their business. Let's look at a statement of cash flows. This is the trailing 9 months, 2023, 2024. Their operating cash flow went down a lot. It was 6.7 billion, now it's 3.8 billion. The main reason was because their net income went down from 10 billion to 3 billion. Let me show you on the income statement. In 2023, their net income was 10 billion, now it's 3 billion. Part of the reason was their revenue went down over 4 billion and their expenses went up over 4 billion. So that'll do it, because their operating income for the trailing 9 months in 2023 was 13 billion, 2024 4.4 billion. In their investing section, they spent 1.7 billion of PP&E last year, 1.4 billion. In their financing section, they added 2.7 billion of debt, paid down 3.2 billion of debt. They bought back 2 billion of common stock last year, 1.1 billion. They only paid out 300 million of dividends, a little more than last year. Let's look at a company on Simply Wall Street. Its last price, 210, 47 billion market cap, up 2% in the past week, up 23% in the past year. It looks like they started trading in 94 at $13 a share. It was as low as 40 cents in 2002. You could have made 1,000x return on this stock, but how would you have known, right? It got low again in 2009. It looks like around $3. It did do well in 2006, over 40 bucks, before coming back down. And then it ran up to 80 in 2014. Then you had the oil crash in 2014, and it came down to 25. Then ran up to 60, then COVID hit, down to about 30. And it ran up a lot starting in March 2020, from 30 to a peak of over 220. So it went up 600% from the COVID lows. It's currently trading at 210, not that much lower than its all-time high. Simply Wall Street's valuation is 225. They say the stock is 7% undervalued. 22 analysts priced this stock at 229. Their revenue was real low in 2013, under 300 million. And then the revenue 10x'd from 300 million to 3 billion. That was by 2017. It was about 10 billion in 2021, and then it ran up to 33 billion. It has come down a lot since that peak, down to 16 billion. We saw that earlier when we were looking at my Excel file. They do use a lot of debt. It was 6.5 billion in 2013. It got up to 31 billion in 2020. Now it's down to 23 billion. But their equity is much lower than their debt. Currently equity of 9 billion, debt of 23 billion. So debt is 250% of equity. About 11% of their debt is cash. So they do have enough cash to service the debt. They do pay a quarterly dividend, and it looks like it goes up over time. It was 1.3% in 2021. Now it's about 1%. They're currently paying 50 cents a share. The forecast is 1.1% by 2026. The CEO's salary was $1.25 million in 2017. Now it's $1.6 million. Total compensation $22 million. Tenure as CEO 9 years. 91% of the company is owned by institutions and 9% by the general public. Vanguard is the biggest shareholder at 9%, then BlackRock, Fidelity. Geode 1.6%, JP Morgan 1.25%, Legal & General 1%, and Goldman Sachs at the bottom of the list. Their employee count went up a lot from 423 to 1,600. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, and London Stock Exchange. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.